Good afternoon, all. This is Trader72. Welcome back to my YouTube channel. It's been a few days, I think, since I was last on. I think the last one was the analysis on Meta, which some of you like. So thank you very much for viewing it. Please do let some comments if you need to, obviously, on the last one and this specific one. But it's good to be back. I'll have a quick overview of the market at the back end of this, but without further ado, I just want to say quickly, basically, I am a retail investor, a small one, and I'm here to really talk very simplistically about what is going on with some of my analysis, some of the markets, what's going on with the market, and who, my thoughts on who we should invest in. So unlike other YouTubers, which are great at what they do, and they, have the language and the jargon, as we would say, of the financial side of maybe potentially they've got finance background, I have not. This is my hobby as a retail investor. I've been doing it for 10 to 11 years, and I've done it all in terms of trading. I've tried many things, but one thing is for sure is I'm very clear about my losses, my wins, where I'm at, and also being quite crystal clear in terms of where I want to be. I've now learned to become more of a value investor, which I feel suits my style more, which is, when I say value, I'm not like a Warren Buffett that keeps a company for 10, 15 years, but it could be up to 2 years, 1 year, 6 weeks, 2 weeks. It really depends on my strategy and obviously trying to make money, which most of us still do. Even so, this is my side, my side job. I've got another obviously job, but this is more of a hobby for me. So you still got to make money and still trying to clear some profit when you can. But strategically wise, now I like to look at it at the longer term, especially if you're going into companies that are slightly more in distress, with a margin of discount on its intrinsic price, which is what we calculate it on, which I've mentioned many of times in my videos so far. This obviously more, but I feel it's less of a risk because you're buying at a certain discount. But anyway, without going into too much of a rabbit hole, as I said, this is what I am about, and like I said, hopefully that will connect with some people that might be new retail investors that have just started, people down the road, maybe a few more years experience, or even more experience that want to hear somebody else talk to them about some of my strategies that might connect with them or not. And for you, whoever disagrees or agrees with me, obviously, on specifically this new analysis, that will be obviously greatly appreciated if you make comments on if you agree or not, and any other questions you may have for me. So without further ado, live here from London, well, not quite live because I'll be recorded by the time I send this out, but it is a stormy afternoon here in London, and let's see if this is going to be a stormy session in terms of my analysis. 3, 2, 1, as you can see here. So without further ado, let's start with number 3 on my chart. Now, before I start number 3, actually, what might be a good idea is just to start it off really with the criteria of this sector, which is the apparel and sports sector, and why there are some major issues within that sector at the moment. And I think all 3 that I've chosen, and some of you may well disagree with my choice, but my choice was really basing it, on 3 US based company. I trade on the US mostly, and I purposely left out Adidas and Puma, which are probably more on the European market, which I'm obviously well aware of, and gone for 2 of the newest brand with an old brand like Nike. Lululemon, Nike, and Deco are the 3 that I've mumble-jumbled in this top 3, from worst to best. And when I mean worst, it's not worse as a company, but worse as what I would suggest where they are at the moment in terms of product and company numbers, figures, and everything else, and who I would invest more into. Now, it doesn't mean I'm going to be investing in them, but this would be where I would be looking at as the number one, the best one, potentially to invest in at some stage. But there are issues clearly with the sector at the moment. So before we do the top 3, let's go quickly through why there are issues. There are economic issues. So why? Number 1, the economic issue. Consumer spending if you haven't got the spare cash, the spare income, you will not be spending on a pair of Nike shoes or a new yoga pants, which are quite expensive, not cheap at best. Let's be honest. Hence why most of their margins for these three companies are quite high. So lack of disposable income is obviously a big issue, and with the moment, the way the things are at the moment, we are in an inflationary or stagflationary, as people would say, situation where people are keeping their money in their pocket. Interest rates are high, so borrowing is obviously harder as well. So that's another issue where people are reducing their disposable income. Inventory. Now, after COVID, a lot of the apparel sportswear company bought a shed loads of inventory, which they didn't get rid of. When obviously COVID ended, there was obviously a gap in the market where people obviously stopped buying from being at home. And obviously there was a huge amount of excess inventory, which they had to discount. And discount means bad for the bottom line. So digital competition as well, online niche fitness brands like Gymshark, Allbirds came into play. So that's kind of added to the pressure on the numbers. Brand fatigue. I think there's been a brand fatigue with the younger Gen Z coming in. Sustainability, inclusivity, social purposes. Just, outlooks on people change over periods and time and generations. So I think that will obviously have a major impact, especially on someone like Nike. Global competition, European based, obviously, and also specifically from Asia, which can do everything slightly cheaper in terms of brands and clothes. That's a well-known fact. Heavy reliance on celebrity or influencers campaign that can also backfire sometimes. That obviously on the one individual, except from I come from an advertising background, in post-production. An advertising background was obviously all about global brands. That rarely backfired because it was an established advertising campaign as opposed to an influencer. So that can also sway some situations as well. Micro events, geopolitical currency fluctuations, obviously. One of the big issues I think recently was, of course, the fact that a lot of these companies, like the three that I've chosen, are heavily manufactured in Asia, with obviously the situation with Trump and the tariffs, which obviously were whacked up by Trump over especially the Asian market. So that stopped from people actually having to manufacture outside the US. That has had a major impact. Of course, investors are cautious about discretionary retail stocks, which affect stock price and valuation. So that's, I would say, there's some of the reasons why the sector has suffered and why all of their stock price are now almost at a 52-week low. All three of them. But high quality business, as you will see. So I'm shaking my hand now. I'm apologizing for doing that. So that's one. Once we got this out of the way, let's go to number 3 in my chart. So from worst to best. And when I mean again worst, it doesn't mean the worst as a company, but worst in terms of where I think they are as a company, what place they're at the moment. And I feel like Lululemon are number 3. Now, Lululemon, as you know, from fantastic clothing, fashionable clothing, yoga based, now athletics based. People that I've known have bought running pants from them, shorts, whatever you want to call them these days. Fantastic quality, super comfortable. So brand wise, you can't fault them for this, really. They cater to men, women, of course, of all sorts. Probably less orientated towards any major sports, more towards, obviously, as I said, a very niche market of the yoga market, but also now expanding into golf and athletics, apparently. So whether that will happen, again, not quite sure, really, at this stage. So let's go back to what we think. So Lululemon, a Canadian-based, founded in 1998, product-based, mostly yoga pants, leggings, etc., as you can see there. Consumer direct to consumer, majority of sales from company-owned stores, e-commerce, obviously, Lululemon, very similar to actually Deco, that you'll see, very similar in that vein. Now, premium pricing has obviously been an issue. I think that a lot of people like to spend money on good quality pants, especially the niche market they've aimed at, potentially has a fairly decent income, and he's investing heavily into online channel and digital community program. Now, why is it last? Well, 3 things really. One of the major things is a slowdown in business in the US. That is, I think, across the business. US has a tremendous amount of consumerism. People like to spend money on good products, and if that market doesn't work, it tends to be a problem, even so the rest of the world is bigger than the States, combined, it is a crucial market, and it has weakened badly in the last few years. So growth is now down to single digit in the States. And the brand is just showing a bit of an early crack in pricing. So that's a big no-no for me in that respect. So it's a premium brand. Fantastic. Now, the revenue growth is slightly lower now at 2 to 4%, but the margin growth on the plus side is phenomenal. 58%, top in class. The best probably actually out of the three in that respect. Operating margin at 20%. And again, strong in premium DTC and China expansion. They are going into China now. Of course, they're losing the States, so they're kind of expanding more internationally. I think the international growth is between 20 and 40%. So again, very decent. Market cap is at 60 billion compared to enterprise to 52 to 57. So again, practically no debt, which is obviously a big plus for me in terms of investing in any company. And if they do have a bit of debt that they can pay back quickly, again, that's debt versus debt ratio. And I think that that's debt versus equity, sorry. So P ratio wise, super cheap right now, 11 times earnings compared to an industry of 18. So that is pretty damn good. Gross margin, as I said, net margin we've gone and go through. Free cash flow, they're sitting on between $1.5 to $2 billion. So that's free cash flow is amazing. Again, because of their high margin, that obviously translates really well. So no problem there in terms of expansion or reinvesting the money, which I think is a major plus there. The DCF model is at 280 to 320. I'll come to that in a minute in terms of where the entry points might be for the charts, because it is at a 52-week low. It's not at 190, it's now at 160, so that's slightly wrong there, or slightly out of date in terms of the actual current price. ROIC is at 34%, phenomenal, well above the 10% criteria that I would normally have for it. Meaning, yes, understanding the business, moat, quite small, but niche, but strong. So I wouldn't say it's a strong moat, and in terms of the market space, and it's definitely very competitive. But in that market, they are strong. So we'll tick it up for now. Management, not sure about really at this stage. There has been a lot of infighting recently about where the company's going. Margin of safety is at 50%, so it's spot on, really. That's probably the biggest margin of safety you can get. My margin of safety is normally between 25-30% off its intrinsic price. So still a quality business. Slow growth is obviously a problem. Worth watching or buying on a deeper weakness. I mean, you are literally at that point. Already mentioned about the international sales growth, premium, cheap at 12. Now, bulls will say it's an overreaction, still premium brand. International growth will carry. The bears will say it's its US is broken, growth is story is over, brand losing edge. Where will Lululemon be in 20 years? That is the question. Now, my thoughts on that is that Lululemon will be is a very good brand, quality clothes. Margins are amazing in terms of gross margin profit. It's cheap at the moment. It's on a 52-week low. However, as a brand, I have my doubts whether they will be around in the next 20 years, even less than that. I think it will be a struggle because it's so niche at the moment. Whether they can expand into athletics, which is a super competitive market, or football or any other sport, golf, I think compared to the other two, it will struggle to get that brand out. It's so I can't see it. They don't have a bestseller neither. So for me, I can see them being taken over in a few years' time. Now, this is only my opinion. Some of you may well disagree with me. Please, like I said, make a comment below. But I think this is why I think it's safe to assume that they are in the third place, the worst place out of the top three for me. So that's Lululemon for you guys. Moving swiftly to Nike, number 2. We know Nike. We know all about Nike. It's a terrific brand. It's the swoosh. It's everything that you can think of in terms of every sport, football, American football, Premier League football. It caters to sports, bodybuilding, training, the shoes, Air Force, Air Max. It's well known. So in terms of brand, it's second to none. It's the global number 1 still, I think, in my opinion, still is. Now, the reason why it's number 2, we'll come to that in a minute. But it's, as you can see from the website, this is just the website, and just to give you an idea there, just give you different visuals in terms of that. Now, Nike, as it stands, core business, obviously, footwear, apparel, sportswear. So it's the only one that actually covers all 3 out of the 3 that I've chosen. Branding, innovation, marketing is second to none. Obviously, big in running, basketball, I've already mentioned this. It's got Nike stores, higher margins, wholesale, blah, blah, blah. It really goes on. Now, there is a reason why it's number two. I think the margins are under pressure. I think the growth has slowed and the turnaround is well in need. New CEO in place. He's an old person that used to work. Old person, sorry, no apologies, not old, but an old employee that's come back after the last management. And we all know, I think we've got a pretty good idea of where maybe it went wrong in terms of its business. But before we get to that, let's go to valuation. 140 to 150 billion market cap. Let's call it 150. But the enterprise value is at 160, which means that it's about 10 billion in debt. So for some of you that may not know, market cap should be above the enterprise value. The enterprise value gives you basically, the market cap is the overall, how much the company's value as a whole, and the enterprise value is obviously gives you an idea of what the debt is. It also involves the debt. So whatever difference there is, that is the debt there. So we'll come to that. It's about 9 to 10 billion. P ratio is at 22, 26. I still think that's quite expensive. I think actually the latest price, trading price, the TTM there is at 32. So it's still quite expensive to its sector of 17. So that's interesting that it's still quite expensive, even at $52 a share. And even on the intrinsic price, it's not quite there yet in terms of compared to the other two, especially for the margin of safety. So stock down by about 30 to 40% off its high. That is, for somebody of that size, it's quite amazing. Some of us may argue that Nike is in the same situation that Coca-Cola was 30 years ago, when it was the biggest company probably in the world up to the 80s, and the world decided to change its habits, and Coca-Cola is still big now, but more on a level term than actually on an trajectory term. So that's probably potentially where Nike is at the moment. It's underperformed for the last 2 or 3 years. It's it's a slow bleed. It's right. It's exactly what it is. Revenues at 50 billion, net income at 5.6, gross margin is still decent at 45%. Net margin is only between 10 and 12, so very poor compared to the other two, in terms of even Lululemon in third, and obviously the other company, Deca, as potential. So that's where we're at. Lower margins, less premium positioning, compared to much weaker profitability than Deca, which we'll see in a minute. And balance sheet is currently at 11 billion versus cash 9 to 10. So it's only 2-3 billion in debt completely. So that's going to easily be being paid back with the amount of free cash flow it has on its book. The plus of Nike is this free cash flow, which we'll see again. Margin safety at the moment, that's based on, again, that needs to be worked out on 58. It's only 25% margin of safety. I think it could be even better than that if it goes into the mid-40s. But again, I'll come back to that in a minute. So ROC is at 14%, just above the criteria of what I would expect for the return on investment, which obviously is a key point for any company. So that's where we're at with that. Now, I think the biggest issues with Nike for me at the moment, and the reason why it fell into number 2, is the fact that they put themselves into a bit of a corner by cutting out the retailer, which is what they were doing successfully beforehand. For some reason, they thought they could go direct to the consumer via their own website, and it backfired spectacularly. So now they're reversing that strategy with a new CEO. So strategy missteps, loss of distribution momentum, discounting to clear inventory. Obviously, the inventory was huge on the Nike side, probably bigger than the other two, so they've had to give massive discounts, which I did notice. Also, a lack of invention, new exciting projects. When was the last time we saw something exciting from Nike? I've got to be honest, apart from the Air Force One, which they've lived on a legacy with, it seems they've run out of ideas. Their shoes don't look great at the moment, especially on the shelves I've seen recently. So I think that is quite dangerous for any brand, the lack of invention going forward, which Nike was well known for. Still huge in terms of sponsorship. It still pays some of the best sportsmen in the world, so that still has got that. But yeah, it's certainly not running the. I think it's lost also a massive amount of margin in terms of moat to smaller brands, as we said before, Gymshark and HOKA and Deco and Lululemon to a point, and other brands. So it's been a tough old time for Nike. Still the number one, still has number one brand, I think, as a whole. It's still got a massive moat, and it's still got a tremendous amount of cash flow at 4 to 5 billion free cash flow annually. So that's quite amazing. So that's where we are. So what do we think about Nike in terms of the Bulls? Obviously, I've got their own brand of it's the best in the world, temporary reset. The Bears say growth is gone, competition is catching up. That's what it is. So it's not broken, but is it broken? That's the question. So key things to watch: innovation, China recovery. Maybe that could help as well. I think it's still the global leader in sportswear. Absolutely agree with that. Where will it be in 20 years' time? Is it going to be, as I said, the Coca-Cola of sportswear? Where it's still there, but it's not quite as successful as it has been. I think that's exactly what it is at the moment. I think the margins are suffering. I think they are suffering. They're losing market share value. Their invention of their latest stock has been pretty poor, and I think they're quite stagnant. And I think that's why their stagnation is left them in number 2. Short of number 1. So that's my opinion. Again, if you disagree with that, let me know. It is everybody's culture of working out what is right or not. There isn't ever a right or wrong. And all of these 3 are actually in distress in terms of stock price, ironically. But again, for the reasons I mentioned earlier on. Number one on the charts. So we are talking about Decker is number 1. Welcome to Decker. And well done, Decker, for my own way actually of thinking things. Decker brand, known for its hog, which my sister bought years ago and still wears now. Wear HOKA. Most people I know wear HOKA. Comfortable, great big trainers. Very much used by probably a young generation of people. Again, very similar to Lululemon. Very, very much in a niche market, but it is one of the fastest running shoes, selling solid shoes at the moment as it stands. Very much catered to the younger generation. I think it started as a kind of it started in Santa Barbara, California. It started as surfing. That's what it was. And at the moment owns HOKA Teva and AHNU. I'm not sure what that is potentially, but it's got hopefully quality of life, individual growth, flexibility, holistic well-being. That's what it's all about, isn't it? So again, very much in that mold. So Decker, outdoor-based corporation. It's really an outdoor company, very much, to people that like to hike, run, and so forth. So it distributes footwear, apparel, and accessories. Probably mostly shoe wear, but it has got a clothing department as well in that respect, targeting lifestyle, outdoor, and sports segments. Known for its sheepskin boots, which obviously I've mentioned already. HOKA One running shoes, known for maximalist cushioning, rapid growth, athletic, and running segments. All a bit of a mouthful, but we got there in the end. Apologies if I slightly mumble my words. Collabora, more affordable version of HOG boots. Interesting as well there. Direct to consumer, wholesale, global presence. The same thing as the other 2, really, pretty much in that market. Market value, market cap 14-15 billion, 12 billion enterprise. That means they are in no debt compared to the other 2. That's quite amazing in terms of their numbers. You will see in a minute. It's what's probably put them in number 1 in terms of the actual fundamentals. Still only at 16 times earnings. That's pretty much in position, or in the same ballpark as the sector. Cheaper, a little bit more expensive than I suppose Lululemon, but cheaper than Nike. It's got a net cash position, which is very impressive. Stocks pull back 20-30%. It's been more volatile than recently than Nike and Lulu, but not a collapse, obviously, and it's down to macro pressure, which we know about. We've already mentioned it. But let's look at these. Look at this revenue, 5.3 billion. But look at the gross margin, 58% gross margin, as good as Lululemon, 20% net margin. Again, very impressive. High margin than Nike, comparable with Lululemon. We mentioned that already. Practically no debt, which is very impressive for any company in that sector. Cash in hand, or free cash flow, $2 billion. What can you say? Fantastic. Strong balance sheet. You cannot. The ROIC, which is the return on investment, which is the money you get and reinvest, is at 74%. I have rarely seen that high in any company. Even the tech companies are not as high as this. So I'm not sure if this is actually a mistake on what was I found out. We probably need to double check that, but it is a phenomenal number in terms of return. It is, they're not cheap, their products, like Lululemon. So they do, again, they cater to a niche market that will pay for this. So quite amazing from that point there. So, growth concern, HOKA may slow down. Yes, potentially. Obviously, there's always a bad and a good to everything. Mixed pressure, consumer environment obviously is a problem, which obviously is for the rest of them. Massive growth engine is the HOKA. That's, I think, the fastest growing shoe at the moment, and hence another reason why I chose it as number one, as well as its core fundamentals. High profitability, super high profitability, which I think they can keep going with at the moment. We talked about the net profit already, the margin. Unlike Nike, no financial pressure, huge advantage in downturns as well. So when there's a downturn, they are pretty comfortable. High quality margin, growth company facing some slowdown like everybody else. Bulls are saying that HOKA was a growth story. Bears say that its growth has already happened, competition rising, etc., etc. So turnaround, potentially that's got to turn around. If the margins can stay above 55%, I think they're going to be around for a while. If they keep growing double digits, international expansion is going to be the next thing, of course, not just the US market. Warning sign, if the growth drops sharply, margin falls meaningfully, that could also be the big problem. Now, will they be around in 20 years? HOKA becomes a global tier running brand. Deca evolves. Well, I think it will be a smaller version of Nike, absolutely, the way it says at the bottom there. I think the way they're going, the innovation, the fundamentals, puts them into number one spot. Now, again, you guys might be completely differ with me. You might also say that actually Deca is not just a sports brand. It's less than Adidas or Puma in that respect to Nike, maybe even Lululemon. But it is. It has got an incredible... It hits the athletics market. It's also within the sector of apparel and sportswear, so it is in there. So for me, looking at the numbers, the fundamental, the story versus the share price, it all connects for me at this moment in time. Now, whether or not they will in 5 years, 10 years, I'm not sure. I think they've got a better chance of surviving than Lululemon have, for sure. If Nike can turn it around, that could take back, I feel, that number one spot. Well, they're already that number one spot, but re-increase it. But right now, the innovation, I think, and the momentum was with Deca. Even so, Deca's share price is also at a 52-week low almost, which we will check in a minute. So that's where I'm at with the top three. I hope you may not agree or agree with me. It's all, subjective, isn't it, at the end of the day, what we think. So without further ado, let's have a quick look at currently the market as it is. Now, let's have a look at the Nike where we are. So Lululemon I've put into third at the moment, as you can see, absolutely rock bottom now. It's now on a 52-week low and a 5 years low, I think, or 4-year low, as you can see from the chart. This is based on a 1-week chart. Currently, it stands at a 50% discount of its intrinsic price, which I think you need to bear in mind is well above the 200 mark. So again, we can double check that for you guys. So definitely a good entry point if you were going to go in, but please do your due diligence on this before you do anything. Check the sector, what the issues are, which I've kind of highlighted. And obviously this is condensed down. So, that could be a great opportunity if you're a contrarian, really, in that respect. Nike could be another opportunity. I would suggest that Nike, because of its PE ratio, is still quite high. It's probably the less of the discount on its intrinsic price. The intrinsic price is between $58 and $60. So right now, you're only going to get 10-15%. I would suggest that you probably wait for the mid-40s before you buy in. I don't think it has gone to its mid-40s for a while. I mean, look at that fall from Nike, from, the highs. Oh, and actually, I'm looking at the wrong... If we look at the actual 1-week chart, look at that rise. From 180 it was back in September 21. And look at that fall. Amazing fall, really, in terms of for Nike. Fall from grace in that respect. Lululemon, and then, of course, the number one, which my chosen one at the moment, which is Deca. The less stressed out of the three, I think, in terms of share price. It was fluctuating around 126. Actually, at the high of 24, it was at 220. So again, a fall from grace there in terms of falling out, well under its 50-day moving average and probably around the same of the 200-day moving average. It has fallen down as far down as 80. I would suggest that 100 is a good entry point. Potentially, if you want to make sure that the intrinsic price is around 30 to 40% of its actual intrinsic price, I would probably buy in maybe around the wait until the 85, 80 mark. That would be my entry point for sure for Deca. But I think Defca is a wonderful business in terms of that it's not reliant on one single best shoe, but two of the best selling shoes in the market at the moment. Things may well change, of course, so watch out. But again, the momentum down, and I think a great entry point. So that is currently the top three. Let me know if you agree or not in the comments below. My analysis on all three sports brands. If you guys want me to do another one on Puma and Adidas, I'm happy to do so as well. But at the moment, I felt that these three were probably the most dominant. I did look at Under Armour, but that was a massive turnaround and really pretty much nowhere near what it was in terms of brand at the moment. So I felt that Lululemon qualified better in that respect in the top three, or even Deca. So that's that. Before I go, let's have a quick look at the markets, because it's been, obviously fairly quiet. The markets are flat as a pancake. There's obviously the issues going on with the Middle East, which you need to check out. It's been, obviously, we're waiting to see what's going to happen from that. So I think the market is on hold at the moment. The crude oil is currently at $100 a barrel, which is just under what it was this morning, around 97.98. And I see the Nasdaq and the US 30, which is the equivalent of the S&P 500, or the Dow, sorry, currently flat. My stocks like S&P Global and Visa have taken a bit of a step back today. It's been a bit painful. I'm not going to go into too much detail for now. I think I've waffled enough to you guys. But yeah, it's a little bit iffy at the moment. I think it could go either way depending on what happens with US-Iran talks and the Strait of Hormuz, whether they deblock that problem out. I don't know if there's such a word as deblock, but it is what it is. There you go. So I hope you enjoy. Please subscribe and smash the like button. And I'm always give me some idea of what else you want me to do in terms of analysis. Always happy to do so. But this is your Trader 72 switching off. It's over now. Take care, guys. Speak to you on the next one.